If I go out and I buy this house for, let's call it $250,000, which yes, it is possible if you're willing to put in some work. And now I'm gonna rent out this property to somebody else. Let's say I rent it out for $2,500 a month. If I do it correctly, this rental income will pay for all my expenses, my property taxes, my insurance, my maintenance, my management fees, my vacancy costs, my mortgage if I have one, and then put some money in my pocket every single month. That's the right way to do real estate. Now, if you're thinking, but Jaspreet, I don't want to be the person that has to unclog toilets at 2 in the morning. Trust me, I don't either. That's why you want a manager, a property manager, who's going to manage the property, do all the day-to-day stuff. That way it can be relatively passive for you, and that's factored into the cost as well. So the number one goal is cash flow. Then we have pro number 2, which is appreciation. Now, real estate is very localized. Some neighborhoods are going to see way more appreciation in price than others, while other neighborhoods are going to see property values fall. Just like anything else, it is localized. Some assets will do better than others. But if you're buying property in a good area, the first thing that will happen is more people want to live in that area. And if the demand starts to rise, then in general, the property values and rent start to go up. So now maybe this property is, let's say, $400,000. That's the new value of this property after a few years. It's a hypothetical, okay? If that happens, well, your rent will also probably go up, which means you get to make more money, but now you're sitting on an asset that's worth more money. Now you have a couple of options. Option number 1 is you can sell the property, and now you have this money in your hand, but you no longer have this asset. But the reason why some investors love real estate is because now you can do a cash out refinance, pull this new value out, buy another property, and the cash that you get in your hand, if you pull out $300,000, well, that's tax-free. And you can use that $300,000 to go out and buy more rental real estate that's going to make you more money, and the tenants are going to continue paying that mortgage for you. Pro number 3 is you own a hard asset. When you go out and you buy this property, you own the land, you own the bricks, you own the windows. So it's something that you can see, feel, and touch, as opposed to stocks or cryptocurrency, which is just a piece of paper that says you own this thing. Here you actually own the physical asset. And last but definitely not least are the tax benefits that you get from real estate. As a licensed attorney who is not your attorney, what I can tell you is that real estate has some of the biggest and best tax breaks that our tax code has to offer. Let me demonstrate. Let's assume for this example that I bought this property for $400,000 because I got a little excited earlier and I already crossed these numbers off. So I bought this property for $400,000. The first thing that the IRS says is I deserve a tax break because I'm buying a physical piece of property. And the way that this tax break works on single-family rentals, not single-family homes that you live in, only rental properties as an investor, is I get to take the value of the property, not the land, the value of the property, and divide it by 27.5, and that's how much of a tax write-off I get every single year. So let's assume that this $400,000 property is $100,000 worth of land and $300,000 worth of building. Now I get to take $300,000 divided by 27.5. Why 27.5? Because that's what the IRS says. But now I get a $10,000 a year write-off. So let's go through this example. I'm renting this property out for $4,000 a month. I gotta pay my expenses. I gotta pay for the property tax, the insurance, the property maintenance fees, the management fees, because I don't wanna be the one that's unclogging toilets. I gotta pay for the vacancy costs and everything else, even my mortgage if I have one. And let's assume now that after paying for all of my expenses, I am left at the end of the year with, hypothetically, $15,000 of profit. This is how much money is in my bank account after paying for all of my expenses. Well, normally when you make $15,000 of profit, you have to pay taxes on $15,000, but this is what the IRS says. Hey, your property is 1 year older. So you deserve this tax break called depreciation. And now I can write off this $10,000 and say, hey IRS, this property is 1 year older, so I deserve this $10,000 write-off. And now you tell the IRS, I made $15,000, but I only have $5,000 of taxable income. You're only paying taxes on $5,000 even though you have 15 grand in the bank. And this is really just tier 1. As you start to get more advanced and you have a better accountant and you start to do more properties, what you realize is you can get a much bigger deduction. That way you make $15,000 and maybe you pay taxes on 0. This is called accelerated depreciation, which allows you to do a bigger write-off in year 1, 2, or 3. But that's a topic for a different video. So the first thing you get with these tax breaks is you get to make more money, pay less money in taxes, which is why a lot of real estate investors can make a lot of money and pay little to no money in taxes, and it's 100% legal. The second thing is if I buy this property for $400,000, I'm not going to cross it off this time, and now it goes up in value to $1 million, hypothetically. Well, if I sold this property that I bought for 400 grand for $1 million, I have $600,000 of gains, which is great. But that also means I'm going to get slapped with a big tax bill, unless I do something special. In real estate, there's something called a like-kind exchange. It's called the 1031 exchange, which says if I take all $1 million here, I go out and I buy a bigger, nicer, more profitable property. It doesn't have to be more profitable. It doesn't have to be bigger. But if I take all $1 million and I go out and I buy another rental property, I can defer all of those taxes. I can buy this bigger property, and I can keep doing this until I die and never have to pay a penny in these capital gains taxes, as long as I own the property for longer than a year and it's a rental property. This is why real estate investors are able to take advantage of compound interest, because they keep buying bigger and bigger properties and never have to pay a penny in taxes, as long as you follow the rules of the 1031 exchange. It has a lot of rules, so if that's something you're considering, get an accountant, get an attorney to make sure you do it right. But it's not all sunshine and rainbows, because there are some cons with investing in real estate as well. Con number one is the cost. If you want to go out and buy real estate, you need some money, period. I know a lot of people like to sell you this idea of no money down real estate, but no money down real estate has made me so much money, because a lot of people buy real estate thinking, I don't need any money, I don't need any experience, I don't need any credit. You're the first one to get foreclosed on, and then banks come to people like me to buy the property off of you for pennies on the dollar. So I am not an advocate for no money down real estate. You need money to go out and buy real estate, which is different than something like stocks, because you can start investing with as little as $100. Number two, real estate also comes with more headache, because you also are the operator. Yes, you can hire a property manager, but it's up to you to hire the property manager. It's up to you to make sure the bills still get paid, and it's up to you to make sure that this property is making money. Yes, you can hire people, but ultimately the responsibility is on you, because you are the operator in this property, which comes with more headache. And number three, it's not liquid. If you wanted to sell your property because you need the cash, it could take 30, 60, 90, 180 days to do that. So it's not always the easiest to get your cash out of the property. And that's why real estate can be great for the right person. And you have to know the right investment strategy for you, which brings me on to number two. Let's talk about stocks. And this is where, if you are an investor and you want to stay up to date on what's happening in the financial markets, my team at Briefs Media publishes a free newsletter called Market Briefs every day, where we break down what's happening in things like the housing market, the stock market, the crypto market, the global economy, and our own economy into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every morning, and it's completely free. So if you have not joined Market Briefs yet, what are you waiting for? I got the link for you down in the description below. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.